You buy into a position, everything looks great, and then out of nowhere, you experience a sudden crash that catches you completely off guard. It leaves you staring at the chart, feeling paranoid that the market is just going to keep falling and wipe out your money. The truth is, the market will always have these massive booms and inevitable drops. To trade with actual peace of mind, you need to analyze and plan before taking your move. Today we're breaking down 4 clear identifiers to help you read the signs early and stay ahead of the game. So, let's get right into it. Number 1. The sharp V-bottom reversal. It looks like a perfect comeback story, but it's often a dangerous trap for eager traders. It happens when a market sharply plummets, typically with 4 red candles in a row, showing that sellers are panicking and exhausting their energy, only for a massive green candle to violently blast the price back up. This sudden bounce creates an incredibly tempting illusion that baits amateurs into buying too early out of a fear of missing out. While hitting the jackpot on this initial spike can yield massive profits, the reality is that the momentum usually dies out, leaving traders stuck as the price flatlines or plummets even further. Instead of gambling on the very first bounce, the smartest strategy is to practice patience and wait for a higher low to form, which I will explain to you later in this video. By letting the price drop slightly and stay above the previous low, it proves that buyers are truly in control. This gives you the safe sign you need before risking your money. Number 2. Bullish expansion. After the V-bottom, the stock enters a steady upward climb marked by large green candles with little to no wicks on either end. These are known as marabozos, and they signal that big institutional investors are pouring serious money into the stock and driving the price higher. This is a promising sign, but it doesn't mean you should buy just yet. If you're an active trader, buying during this rise is risky because the price is just as likely to drop as it is to keep climbing the moment you enter. The smarter move is to wait for the stock to reach its peak and stabilize before making your move. Once you see a price bounce at that consistent level, that's your entry point. For long-term investors, however, buying during this phase is actually a reasonable decision, since short-term fluctuations matter far less than the overall trend. Either way, recognizing this phase gives you a clear advantage. You'll know exactly where the market is heading and how to position yourself with confidence. Number 3. The higher low. As I mentioned earlier, the higher low emphasizes that the buyers are in control. And now, here is exactly what that means. After the bullish expansion drives the price upward, it's completely normal for the stock to take a brief pause and pull back slightly. This is known as a higher low, a small, natural dip in price that follows a period of strong upward movement. The key word here is higher, because even though the price dips, it doesn't fall back to where it started. It holds at a level that is still higher than the previous low, which is exactly what makes this a healthy sign in an uptrend rather than a warning signal. What this dip tells you is that demand for the stock remains strong. Investors who missed the earlier run-up are now stepping in and buying at these elevated prices without hesitation, confident that the stock still has room to grow. That continued buying interest is what keeps the low higher and prevents the price from collapsing back down. From a trading perspective, this phase also presents a strategic opportunity depending on your position. If you already own shares, the higher low can be a reasonable point to sell and lock in your profits, especially if you believe the stock may struggle to push significantly higher from here. On the other hand, if you believe the price is set to fall further, this could be an opportunity to short sell, borrowing shares and selling them at the current price, then repurchasing them at a lower price after the dip to pocket the difference. Either way, recognizing a higher low gives you a clear, informed moment to make a deliberate decision, rather than reacting emotionally to price movement. Number 4. Bullish grinding channel. A bullish grinding channel occurs when a stock's price continues to climb, but the upward momentum slows down and the price movements become much smaller. Because there isn't any heavy selling pressure yet, the market sits at a tense tipping point where the price could either suddenly skyrocket or sharply plummet. This makes it a highly risky environment for traders. If you want to protect your gains, the safest move is to sell immediately and lock in your profits. However, if you are looking to short sell, you shouldn't rush in. Instead, wait for the trend to break or flatten out, which signals market hesitation. A smart short selling strategy is to wait for a lower high. While short-term traders might try to time the absolute peak for maximum profit, long-term investors should be cautious about selling too early and missing out on future growth. No matter your strategy, the most important rule in a grinding channel is to avoid panic selling. It is easy to freak out at the first sign of a dip, but you must remember that the buyers on the other side of your trade are just as anxious and uncertain as you are. Instead of reacting emotionally, the best approach is to stay calm, closely observe the market, and wait for clear confirmation of the price direction. By resisting the urge to make impulsive moves at the first red flag, you can protect your capital and execute your trading plan with discipline. Those are the four major stages to watch out for before a market crash. Keep in mind, these technical analysis indicators only hint at a potential drop. They aren't a guarantee. Think of technical analysis like checking the weather radar. It shows you what the clouds are doing right now, but it doesn't tell you why the storm system formed in the first place. That is why fundamental analysis is so crucial. While charts give you raw insight into price patterns, fundamentals provide the deep context, the real-world economic data, company health, and market news that actually drives those price movements. If you want to maximize your trading results, don't rely on just one side of the coin. The most successful investors combine both technical and fundamental analysis to build an unstoppable strategy. That wraps it up for today's deep dive. If you found this helpful and want to stay ahead of the next major market shift, make sure to smash that subscribe button and hit the notification bell for more breakdowns. Thanks for watching, and until next time, stay bullish.